Welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today I dug through all the data and tried to come up with 6 undervalued stocks. This sizzling hot market continues to go up after the lows that we saw in March. It's getting harder and harder to find stocks that are technically undervalued, that still have a bright future in front of them. But I think I found a few here that you can add to your watch list and maybe make a couple bucks off of. Just a reminder, as always, my stock picks and projections are my opinion only. Please go talk to a financial professional before taking on the risks of the stock market. However, if you do enjoy stock deep dives like this and talking about investment ideas, personal finance concepts, and stock market analysis, then please subscribe to the 40 Finance channel. Thank you to everybody who's supported the channel so far. All right, so let's dig right into our 6 stocks. Number 1 on the board today is Cirrus Logic. Cirrus Logic makes audio chips and technologies primarily for phones. Their biggest client is Apple. Stock price today is at $60.21. The market is actually up. I'm doing this in the morning and the market is up yet again today, so it wouldn't surprise me if Cirrus is already up for the day as well. You have a 52-week range of $41 to $91, and you see on the chart off to the right that Cirrus is still down from their highs here in January, so still a little bit of room to run. And what I like about this stock is just that Apple has had its own sort of pains going through the pandemic, and yet we still have 5G launches coming up. It's anticipated that Apple phone launches will be delayed slightly, but I think you can get into this one prior to a big boost to the stock when 5G and all the Apple phones actually do come out. You got a forward PE of 17.48, trailing 12 months revenue of $1.28 billion. So this is a very nice sized company. Cash on hand of $314 million and a very small debt load of under $150 million. All right, one of the things I'm going to do for all 6 stocks today is take a look at the TipRanks dashboard to see what do the best performing analysts in TipRanks have to say. What are they speculating for the next 12 months for each of these stocks? Shout out as always to TipRanks. I am a paid subscriber. I use their service to get a handle on analyst projections for stocks, look at hedge fund activity, insider trading, all those things that you don't really see in like Yahoo Finance or CNBC. My affiliate link for TipRanks is in the description. If you want to check the service out and potentially support the channel, I definitely appreciate it. On the Cirrus side for TipRanks, we have 5 of the best performing analysts reporting on this stock. You got 2 buys, 2 holds, 1 sell. Median price target is $79.67, which by this morning was a 31% upside potential over the next 12 months. And you got a high bar of 95 and a low bar of 60. So again, the analysts here are kind of agreeing that there is still potential in Cirrus going forward. I think if you're interested in this stock, you start to dig into what is the potential for the Apple product launches coming into Q4. Potentially, is there any other vendors, since Cirrus is a little heavy on Apple, actually very heavy on Apple, what is their potential to expand to other phone makers and chip integrations? If you can find some research in there, this might be a great long-term hold. All right, next on the board is Viacom CBS. And Viacom CBS trading right now at $23.60 before the market opened this morning. You have a 52-week range on this one between $10 and $53. So we're settling in at about the halfway point. And what's great about this one is you've got a low PE. It says NA here, but it's actually not that. And you can see the forward PE is 6.31. You got tons of revenue, trailing 12-month revenue of $27 billion. They do have a high debt load and a low cash volume right now, which is a little bit concerning. But I think for the future for Viacom is you're just buying this one. It's still in a sustained dip from what we've seen going on in the world. And CBS has a lot of sports rights that they hold, Final Four, Masters, NFL, all these things. They've really got hit really hard on the sports contracts. However, I don't see this. I see this as a one-time problem, right? And now that problem could carry on all the way through 2020, but they're still doing a nice dividend, 4.12% as of today. So if you believe in all the property, intellectual property that Viacom CBS holds, I like this one as a bounce back candidate. And quite frankly, over the short term, even if the price doesn't bounce too high, you're still eking out some dividends in there. It might take 12 plus months for this one to really return back to normal. And you're going to see a lot of bears talking about things like cord cutting, etc. I think Viacom's property, their intellectual property, can survive cord cutting simply by the intellectual rights that they can resell for some of their popular shows that they have on Nickelodeon. I think they also do some of those crime shows like NCIS or whatever that is. Anyway, so speculation here, but I like where Viacom sits from an undervalued standpoint. All right, on the tip rank side of things, we got 6 buys, 4 holds from the top performing analysts. Median price target of $27.78. That's only a 17% upside from today, but frankly, in this market, it might as well be a 40% upside because you've got things that are trading at 52-week highs that frankly, they just don't deserve to have that number. But nonetheless, you do have a high analyst at 45, you got a low at 18. Don't forget that dividend, and you're really going to have to buy into the theory that CBS is hit on their sports properties as well as potential cord cutting as people struggle to pay bills. Those are all things that are at play here, so you just have to decide which side of the fence you're on. All right, next up on the board is LKQ Corporation, and this company generates almost all of their revenue from vehicle parts. So not only do they resell reconditioned parts that they grab from their network of salvage yards, but they also sell what I would consider like imitation OEM parts, right? So anything to do with engines and body stylings for not only cars, but campers, trucks, all those things. That's what LKQ does. And I was really intrigued by the bull case for this company, and that is car turnover is going to be slowed down, right? People buying new vehicles as investments in existing cars increase. We'll have to see if that holds true, but LKQ by itself is a pretty decent company even in a normal day. You see the stock price today at $25.08, 52-week range of $13 to $36. So we're landing again just a little bit over the middle there. P ratio is 13.14. We got a forward PE of almost 16. Trailing 12-month revenue, guys, $12 billion. This company is no slouch. They're bringing in $12 billion a year. Cash on hand of $300 million and a debt load of $5 billion. So a little low on the cash on hand, but plenty of 12-month revenue to service that debt load at any time. All right, on the tip rank side of things, we got 5 analysts covering this stock. We got all buys. 5 buys, no holds, no sells. Median target of $35.75. That's a 41% upside from today. You got a high bar of 41 and a low bar of 30. So LKQ, take a look at this one if you have any understanding of the automobile parts market or you have a bull thesis on automobile parts going forward in this current situation that the world's in. All right, next stock on the board is ROST Stores, the discount clothing retailer. And I am a stockholder of TJ Maxx, so I feel like I follow this industry quite a bit. I do not own ROST Stores, but what I'm seeing with ROST Stores is a company, obviously with the closure of retail in the spring, is still not really sprung back to life yet from a stock perspective. Meanwhile, over at TJX, which is a stock that I own, I've seen a lot of life. They're not quite back to 52-week highs, but I think the 52-week high on TJX is about $65. They're riding in the 52, 53 range. I think ROST is coming in a little under that pace, so there might be an opportunity here. Current stock price at $87.19. You see the 52-week range for ROST Stores, $56 to $124. So if you go back to February, this stock was at $124. You got a P ratio that's a little high in retail land at 33.39. The forward PE goes up a notch further at 45.87. But what you're buying here is probably a 12 to 18 month return, right? So you're getting it in at 87. It's bounced a little bit since the spring lows, but it's sort of hovered in this 87 land. Could be something interesting there. You got $14 billion revenue over the past 12 months, so this is definitely a chain of stores that drives revenue very strong. Cash on hand, nice cash load of $2.6 billion, and the debt of $6.3 billion, once again, is certainly manageable given the type of sales that they're doing. All right, taking a look at the Tip Ranks dashboard for the best performing analysts. Once again, we have 8 of the best performing analysts covering ROST Stores, 7 buys, 1 hold, median price target of 104.25. So that's up a little over 20% from today. You got a high bar of 110 and a low bar of 97. Now, one thing I forgot to confirm, but if ROST Stores is like TJX, they typically do offer a dividend. TJX paused theirs. ROST is not showing one on this screen. So I'm going to assume theirs is on pause but could come back. Double check that information though. If that's true, nice little extra bonus while you're waiting, 12 to 18 months for this one to bounce back to its former highs. All right, next on the list, similar to Viacom, we've got another media company that's still struggling to find its grounding. That is Discovery. Don't forget that Discovery not only has the Discovery Channel, but it has the Travel Channel, HGTV, Food Network, lots of things going on with this company. And right now, the Bears, I almost said Bulls, the Bears are winning because of this, concept that ad dollars are down, cord cutting, nothing but negativity coming out of the Bears. From my end, I do see an opportunity possibly to buy this specialized media company at a low price and ride it out for a little bit. Stock price today at $21.07, 52-week range, 17 to 33. So again, you're only a few points off of the 52-week low. Got a P ratio, guys, of 8.39, forward PE of 7.69, trailing 12 months revenue, $11 billion. Okay, so this is no slouch. This is no basement operation YouTube channel, right? Media company. This is a real deal here. Cash on hand of $1.46 billion, and you got a debt load of $16 billion. So fairly manageable, certainly compared to what we saw with Viacom. On the Tip Rank side of things, we have 4 buys, 6 holds, median price target's only $25.88. That's still a 20% upside, even though the stock is a little cheap. It's a 20% upside, which is what it is. High target of 33 and a low of 19. Again, this is one where you're going to have to settle on your internal convictions, right? Do you see Discovery will return back? You're not worried about cord cutting. You feel pretty good about their optional opportunities through streaming networks, etc. Do you see ad dollars coming back? If you do, this could be a really nice play. All right, last one on the board. This one was also from my plus 50% picks, looking ahead to 2020 before all this pandemic stuff. And that is Benefytt Technologies, formerly ticker symbol HIIQ. And Benefytt Technologies has sort of come into 2020 and changed a little bit of their direction. A lot of what they did in the past with their lead website, healthinsurance.com, was selling everything from part-time health insurance, gap insurance, things like that, to regular insurance needs, but they've shifted a lot of their focus because they see a big opportunity in Medicare. So all seniors qualify for Medicare, but Medicare doesn't pay for everything, and there are out-of-pocket expenses. So that's where Benefytt Technologies can offer you like a supplemental package, particularly if you're not well and you have a lot of medical bills, where Medicare, they can supplement the insurance and the gaps that come through that. So that's their big lead going into 2020. That's the market they're attacking. It's a little bit of a transition year for Benefytt. They switched from HIIQ, Health Insurance Innovations. Now they're Benefytt Technologies. They got some groundwork to do to really stabilize their foundation, but they're jumping right in. That's what the story is here. Stock price today at $20.67. You got a 52-week range of $15.60 all the way up to $30.75. So we're still short of the halfway point with some opportunity. No P ratio registered on Yahoo. I don't know if that's actually true though. You see that the forward PE is 5.51. Trailing 12 months revenue under $500 million. So this is a small stock, and that's something you have to keep in mind. $366 million on the trailing 12 months revenue. Cash on hand of $5 million, debt load of $209. With their revenues, you're just going to have to assume that they're looking to grow, right? This is a small company that's looking to grow. So eventually you'd like a better ratio on that debt load, but I would still say that's manageable. All right, now on the tip range side of things, Benefytt Technologies is sort of an up-and-comer, and a lot of analysts are looking at it as a small cap stock with a lot of potential. And to be fair though, it's been that way for about 2 years now. So when will it break out? It's hard to say. But when it does, analysts are projecting big things. Right now we have 4 of the best performing analysts following this one and covering it. You got a median price target of $52.25. That's over 100% increase from where we stand today. You got a high bar of 75 and a low bar of 40. So theoretically, from an analyst standpoint, easy money, right? You got easy money over the next 12 months. The catch is that this is a really small company, and it reminds me a lot of what I've suffered through on Turtle Beach, which is like everybody thinks that the big day is coming, but then it doesn't come, right? And you're stuck holding this stock for a lot longer than you really wanted to get those gains. So that would be my warning. I think that there's opportunity here. I personally will buy some shares at $20, just knowing that it could take a while to get that return. Or on the bright side, something big happens with the state of the world that we're in. Something happens with Medicare. I don't know what it is. I don't have that bull case. But then all of a sudden, Benefytt Technologies and their focus on Medicare, they swoop in and profits go up 50% or some version like that. That's what we're looking for, and probably eventually a buyout target from one of the big health insurance providers. I've got no news on those fronts, but maybe add it to your watch list. Follow Benefytt, see if you can feel any of the wheels turning, and try to get in later right before the pop hits. All right, guys, so there you have it. 6 undervalued stocks here in this market that goes nowhere but up. It's hard to find these, right? And most of the consensus is save your money, wait for the next dip. I believe that fundamentally, but we still have to be picking through the data, trying to find opportunities that when the price is right, we can pick them up, if anything else, for a short-term win. Hope you guys enjoyed this video. Please give me a like and subscribe if you did. I will see you on the next video.